If you're tired of giving all your hard-earned income to the IRS and literally destroying your opportunity to be able to build generational wealth, you're going to want to stick around through this whole video because I'm going to be sharing with you the best strategies that you can go ahead and utilize today that's going to help you be able to save money in taxes, but then also build generational wealth. So let's get into it, okay? So the first strategy I want to share with you is real estate. And as you probably already know, real estate has created more millionaires in the United States than any other investment opportunity. One of the reasons why that is because everyone needs a place to live, okay? And with real estate, you are literally being able and putting yourself in a position to be able to take advantage of this huge demand. So with real estate, there's some amazing tax benefits and they can apply to you whether you're a business owner, whether you're just working a 9 to 5, or whether you're already an investor. Okay, so let's get into some of these real estate investment strategies and also tax saving strategies because, like, again, real estate is such a phenomenal way to be able to create wealth and build wealth for yourself and your family. So let's get into the first one. So just by owning your own home, okay, so by owning a home, by being a homeowner, the IRS actually gives you some tax benefits and some tax credits for being able to own a home. Okay, and if you're not aware of the tax code actually is like a reward system in a way. Okay, what the government was able to find out and determine was that they were able to influence people's behaviors based on how things were taxed, and because of that, they want to encourage people to be able to become homeowners. Okay, and there's a lot of reasons for that. I'm not going to get into the details of that, but at the end of the day, by being a homeowner is going to allow you to be able to take advantage of some amazing tax strategies. Okay, so getting into the first one, by being a homeowner, number one, you're able to not be able to have an opportunity to be able to itemize your deductions. So it's going to give you more opportunity to be able to itemize your deduction. So what is an itemized deduction? So when it comes to getting your taxes done, you have what's called a standard deduction and you have an itemized deduction. And if your itemized deduction exceeds or is bigger than what the standard deduction is for the year, you're going to be able to have an even bigger tax savings, okay? And potentially even a tax refund. So this is how it works, okay? So let's say, depending on the year that you're watching this, let's say for instance, the standard deduction for a single person is going to be $14,000. So if you're able to get your itemized deductions to $15,000, $20,000, $30,000, then you're going to be able to save more money in taxes, potentially even get a refund. So as a homeowner, you're going to be able to take advantage and be able to deduct your mortgage, interest, and property taxes, just to name a few. So that is amazing. But as a business owner, this gets even better for you, okay? So as a business owner, you're not able to take advantage of what's called the home office deduction, okay? And the home office deduction allows you to literally be able to write off a portion of your living expenses just by being a business owner and just by being able to operate a home-based business, okay? And so the way it works is this: when it comes to the home office deduction, you have what's called the simplified method and you have the actual method, okay? Anytime the IRS makes something simple, it's usually going to give you a lower tax benefit. So I'm going to break down the actual method, then we'll talk about the simplified method, okay? But as it relates to the actual method, what you want to do is you want to take the total square footage of your home and then identify the total square footage of a room or a space within your home that you're using exclusively for business purposes, okay? So that's one of the requirements. So you have to be a business owner to do this, and you have to be able to use the space exclusively for business purposes. So let's say the total square footage of your home is 2,000, okay? So let's say the total square footage of your home is 2,000 and the total square footage of this office space is 200. What that means and what that allows you to do is now allows you to be able to take 10% of your living expenses, okay? So you have 200 divided by 2,000, that's 10%. Now you're able to take advantage of the costs associated with your living expenses, such as your utilities. So if you're paying for the internet, if you're paying for phone services, that's now going to be tax deductible for you and allow you to be able to save more money on taxes as it relates to these expenses that you're probably already paying as a homeowner. So next, let's get into even more investing, okay? So let's go even deeper as it relates to real estate investing. So as a real estate investor, there's different ways that you can invest, okay? You could be a wholesaler, you could be doing fix and flips, you could be doing buy and holds. There's all these different types of real estate strategies and things that you could be doing, okay? But I'm just gonna keep it simple and focus right now on if you're doing like a buy and hold strategy. So let's say now with this buy and hold property, you're now spending money, you have a tenant, okay? So the tenant is basically paying down the mortgage for you, so that's another benefit. So basically they're paying down and allowing you to be able to get equity into the property. But then with that, now you're able to go ahead and utilize what's called the Schedule E. And on the Schedule E, it literally lists out every single tax deduction that you're able to take as it relates to being able to now own this property. So a couple things that you're able to deduct. So you're able to go ahead and deduct the utilities for the property. You're now able to deduct travel and commuting over to the property to be able to look at the property, service the property. You're now able to go ahead and deduct for the property manager. So you can go ahead and hire a property manager to manage the property for you, so you can actually make passive income income and not necessarily have to be focused and spending all your time worrying about this property. So again, you want to make sure you check out that Schedule E. You can think of E as equity, and that's going to help you remember it, but that is going to be an opportunity for you, okay? Along with those expenses, you have advertising and so much others, okay? So that's going to be a really amazing opportunity for you. And one of the best strategies as it relates to being able to have investment property is depreciation. The reason why I love depreciation is because it's a deduction that you don't necessarily have to spend money on, okay? Let me explain. And let's say you go ahead, for illustrative purposes, you go ahead and put down 10% on that property, which is $50,000. Well, guess what? For each and every single year, you're not able to deduct a portion of the total purchase price, not necessarily what you put down, not what you're paying out each month, but a portion of that based on the depreciation rate that the IRS gives you, okay? So let's say it's $500,000 for a residential property. You're able to write that over 27.5 years. So if you take 500,000 divided by 27.5, that's going to be 18,181 each and every single year for the next years as you own that property. So that is an amazing benefit, okay? So one of the great things about this is you're not paying out of pocket 18,181. You're actually going to be able to take that as a tax write-off, which is called depreciation, and that's going to reduce your taxable income. Why? Because on paper, what it's going to show is that that property is actually losing money. So let's say you go ahead and receive rental income from that tenant for $1,500 each and every single month. That's $18,000 during the year. So now you're going to have a $181 loss each and every single year that you can go ahead and apply to your other income. Let's get into the next strategy, which is investing in a business. And what do I mean by investing in a business? Okay, because there's actual different ways for you to be able to invest in a business. So you can invest in a business such as going ahead and creating your own business. You can go ahead and buy a business, or you can invest into a business through the stock market, okay? So the first one I want to share is actually investing in a business that you own, okay? So in regards to going ahead and investing in the business, the one I want to focus on for now is talking about how you can go ahead and invest in the business that you're creating. So if you're currently not a business owner, it's probably one of the best things that you can do to save money on taxes. Why? Because now you're able to take a lot of your personal expenses and turn those into a tax write-off. Okay, as I mentioned earlier in this video, the IRS created the tax code, and the government wants you to be a business owner. Why? Because by being a business owner, you're able to create products, you're able to create services, you're able to employ people. That's one less person that the IRS has to go ahead and pay unemployment to. So by going ahead and having this business, it's going to open the doors up for you to take advantage of a whole bunch of tax strategies, okay? And I talk a lot about this in this video over here, so you can go ahead and check that out. I'll link it to the description below as well. But also, you want to know, as a business owner, you're literally able to now take things that you're already spending money on, such as your vehicle expenses, your home as well, meals, travel, your kids, like all these different things that you're already spending and money on, you're able to take these as tax deductions, okay? So as a business owner, I want to go ahead and break down exactly what the main tax strategy that you're going to be able to take advantage of, and that's going to be being able to take advantage of Section 162 as it relates to the tax code, okay? So I actually created an acronym for you to be able to help you remember exactly what you need to know as it relates to being able to write things off for your business, and I call these tax-free deductions, okay? And the reason why I call these tax-free is because these are permanent tax deductions. So there's other tax strategies that are out there that you could save money on taxes this year, but then you have to pay taxes on it later, okay? And that's called tax deferral. So that's a tax deferral strategy. These are actually permanent tax deductions that once you go ahead and take the deduction, you have the deduction forever, okay? So you're tax-free forever. So let's go ahead and get into the acronym. I'm going to quickly break it down for you. It basically mirrors what's in Section 162 and the tax code, okay? So the first letter is going to be F, okay? And F stands for your business, trade, or profession. So one of the requirements is that you have to be a business owner in order to be able to take advantage of these tax deductions, okay? The next letter is going to be R. R stands for regular. The IRS calls that ordinary. So the expense needs to be ordinary for your type of business. The next one is going to be E, essential. What's going to be essential in order for you to operate your business? The IRS calls that necessary. And last but not least, E, economical, not lavish or extravagant is basically what the IRS defines that as. So I'm going to break these down and give you some examples, some practical examples that you can go ahead and utilize in your life, in your business that you're probably already spending money on, okay? A great one is going to be how to pay your kids through the business. So being able to pay your kids through the business is a huge tax deduction, okay? So one of the great advantages of being able to pay your kid through the business is you're able to take that as a tax deduction from your business, and then also be able to build them and set them up to where by the time you do this for them, let's say you go ahead and start them at the age of 7, by the time they turn 18, they could have close to 6 figures in their bank account just by being able to do this, okay? And like I said, I talk more about it in the description below, so make sure you check that out and check out the video, but that's something for you to consider as well. But the main thing I want you to take away from this is understanding by meeting those 4 requirements, the tax-free requirements, it's not going to allow you to be able to figure out, okay, instead of asking yourself, can I write this off? you now understand, you're now equipped, you're now empowered to understand how can I write something off, okay? And basically the way you're able to write something off is by meeting those 4 requirements. So by meeting those 4 requirements, you're now literally able to take your personal expenses and make those into business expenses, to literally turn your lifestyle into a tax write-off. And that's what the rich do, and that's what the wealthy do, and that's one of the strategies that they use to be able to save money on taxes, but then also increase their wealth. Getting on to the next strategy here, it's going to be now being able to invest in retirement vehicles, okay? So retirement's a really powerful way for you to be able to build your wealth, but then also be able to save money on taxes as well. So let's go ahead and break down some of these strategies that you're going to be able to utilize. And if you've been getting value so far, make sure you go ahead and subscribe and like the video, okay? So let's get into the retirement contributions, okay? One of my favorite ones to go ahead and utilize is what's considered the traditional IRA. So what does IRA stand for, okay? So IRA stands for individual retirement account. So this is a retirement account that you can go ahead and create outside of your job. You don't necessarily need to do it with your 401k, which we'll talk more about later, but it's outside of your job, to where now you have the flexibility to be able to invest in different investment opportunities. So instead of being limited to the 401k options, you now have the ability to use other types of investment opportunities, such as investing in real estate, investing in private market securities, and so much more. And that's why I love the IRA, because it's going to give you a pre-tax contribution. What do I mean by a pre-tax contribution? So let's say, for instance, depending on the year that you watch this, let's say, for instance, you're able to now deduct, the maximum deduction is $6,000, okay? Let's say you go ahead and deduct $6,000, contribute $6,000 into this traditional IRA. Okay, now you have a $6,000 tax deduction into your retirement account. With the one thing to know, it's called a pre-tax contribution. You're not paying taxes on it, but you do have to pay taxes on it when you go ahead and pull out that money for retirement. Okay, so that's the one thing to know and one thing to keep in mind if you're going ahead and investing. But just think about this. So let's say, for instance, you go ahead and max out this traditional IRA, and let's say you're at the 30% tax bracket. You're now able to have a tax deduction of $1,800. Okay, so that could be pretty substantial for you. And not only that, you're able to go ahead and get that tax savings and build wealth at the same time. All right, moving on to the next strategy. Okay, this one's going to be a game changer, and it's maximizing your traditional 401k. Okay, I know I keep talking about this retirement thing, but again, retirement has been proven to really be able to build wealth over the long term. And Albert Einstein said this, that compound interest is the 8th wonder of the world. Okay, so by being able to take advantage of the traditional 401k, you're able to have that pre-tax contribution, and it's going to be able to give you a bigger deduction than that traditional IRA. So let's say, for instance, depending on when you're watching this, let's say the maximum contribution is $20,000. You go ahead and contribute to that account. Now you have a $20,000 deduction, but again, it's going to be very similar to where you do have to pull that money out and pay taxes on it when it comes to retirement time. So let's move on to the next strategy, which is going to be the health savings account. The health savings account is what you can go ahead and utilize to be able to create a savings account for yourself in the event that you have to go out of pocket to be able to pay for medical expenses. And one of the things I love about this is you get a tax savings, but then also you're able to be prepared and be able to save some money on taxes as well. And when it comes to being able to improve your financial future, one of the best things that you could do is continue to self-educate, okay? I believe that the more you learn, the more you earn. And in this next video over here, I break down the exact strategies that you need to be able to save even more and take advantage of all these tax strategies, okay? So again, if you like this video, make sure you subscribe, like it, and I'll see you in the next one. Take care.